Bring in Eva Ados. She is COO of Shares. Eva, good to see you. Happy Friday to you. I'd love to get your thoughts on what is going on with the tech space right now. Is all this volatility mostly technical algorithms at play, or are we having real live individuals continually rotating out and then getting back in to take advantage of lower prices?
So what we are seeing is a rotation from value to technology. We think this will continue. We need to have in mind that some value stocks are right now priced at an all-time high, even though they have weak financial statements. In some cases, they have bankruptcy risk, and if you think about how their models and the algorithms work, they use the PEG ratio, price earnings growth ratio, and that takes into consideration growth. But in the case of value stocks, it's coming from a very low level. So we're seeing some value stocks right now priced at an all-time high, even though the revenues are not even close to where they used to be 5 years ago or even pre-pandemic, and they might never reach that level.
So how much further do you think these growth stocks have to go before they reach a floor?
So when it comes to growth companies, there are three key factors in evaluating them, and why we believe we think that growth can continue to do well and better than even value going forward. First of all, we need to remember that the discount rate, which got all the attention lately with the interest rate increases, is insignificant when it comes to growth stocks because they're already discounted at a very high rate. Also, growth is what really matters with the hyper growth companies and not the discount rate. So when it comes to growth companies, if there is not a significant change, any new information coming out about a drug failing or a technology failing, a significant drop in their price is not justified. Also, another issue that we're seeing is we're going to have this year real GDP growth, probably close to 6.4%. Studies have shown when that happens, technology tends to do very well. And the third factor that we have to have in mind is that this year our economy will have very strong fundamentals, and that will provide money in the cyclicals to spend in technology solutions. Of course, that's going to benefit technology. If technology did very well last year when we didn't have all this money around in the system, investing in technology is going to do even better this year.
Would love to get your thoughts, too, on the Federal Reserve and what they did this week at their meeting, which was essentially just reconfirm that they're going to be there and do whatever they have to do until the economy fully recovers, and that rates should remain low through 2023. But yet we're continuing to see this march higher for bond yields. What do you make of that? What do you think the investor psyche is there?
We think inflation has been unfairly blamed. As you said, even though the Fed tried to calm things down, we saw interest rates going higher yesterday. So we think we need to investigate other factors. And there are multiple factors that come to the table when it comes to interest rate increases. It's not only inflation. For example, 7 trillion of US debt is owned by foreign holders, 2 trillion of which is owned by the Chinese and the Japanese, 1 trillion each, 1 trillion China, 1 trillion Japan. And we have to remember that last year, for 5 straight months, the Chinese were selling our U.S. treasuries. And of course, when interest rates go higher, that means it's a mathematical certainty, in fact, that people are selling their bonds. So, and of course, that will trigger extra selling and stop losses. And we think that's a potential scenario. We don't have the data yet of what's going on right now, but in 1 or 2 months, that data will be revealed, and that might be a potential scenario why interest rates are going higher and inflation might not be the reason.
All right, we're going to be watching that. We'll talk to you when that report comes out. Eva, before we let you go, I know that you are taking a really close look at biotech stocks right now. Why and what do you like in that space?
So we like biotech, of course. The coronavirus pandemic put a spotlight on it. The Global market size for biotech is estimated to reach $83 billion by 2027. And China already put a spotlight on it. It's going to be one of the 7 key technologies they are going to focus on in the next 5 years. So there's a tremendous shift out of traditional medicine into new age medicine and treatments. And in fact, we're seeing entrepreneurial companies in the biotech area investing 500% on average in R&D compared to traditional players in the last 3 years, 500% in the last 3 years compared to traditional players like Pfizer and Johnson & Johnson, who are investing only 10% in the last 3 years. So we are seeing a great shift in amount of investments in biotechnology in the future, and we think it's really going to make a difference and hopefully save people's lives.
Hopefully. Eva Ados, COO of ER Shares, thank you so much for being with us.